Hey, are you one of those people who have a really good job, you're making good money, and you know that you have some money left over at the end of each month or each pay period, or out of your business operations from profits, and you're wondering what would be a way to really organize your finances when you have so little time to do it? And we have a guest today, Blake Brogan, who is actually helping us to understand what a capital avalanche is and how you can organize your finances when you don't have a whole lot of time to manage things, but how you can also make your money work multiple times for you. And then when you have arranged it all correctly, I hope you would come back to us at Idea Wealth Grower and have us help you invest in real estate. So let's listen in and see what the capital avalanche actually is. Hello and welcome to another episode of the Ideal Investor Show, and where we bring in great guests to talk about things that have to do with investing in real estate and passive income and so forth. And today we have a great guest, Blake Brogan from Money Insights. And welcome, Blake, to the show.
Hey, Axel, thanks so much for having me.
Yeah, awesome. Thanks for making the time. So let's talk first a little bit about, how did you come to be with Money Insight? What is it? And how did you even get involved in the whole investing world, so to speak?
Yeah, sure. So I've always been interested in business. I mean, even dating back to college, I studied entrepreneurship as a major. So I've always been interested in business and investing. I probably think a little bit outside the box too as well. So kind of carving our own path always was interesting to me. So then I got started in the financial world pretty fresh out of college. Had the opportunity to sit in quite a few meetings and kind of, learn from some older, wiser people above me. And I really started to find that a lot of the traditional kind of retirement methods either weren't working great or people just weren't excited when they got kind of towards the end of the road. Maybe they were hitting age 65 and looking to retire. They didn't love some of the things that they were doing, or maybe it just didn't work out the way that they had envisioned. So I started down more of an alternative route, teaching some alternative financial strategies, helping high income earners create cash flow, do some of the things that you're doing as well. And that's what led me to Money Insights, which is a firm that's been around for about a decade, a little over that. And I think they're one of the best in the space. And so partnering up with them and doing the same kind of things that I was passionate about just made sense. And that's how I ended up with them.
Okay, yeah, that's very cool. Now, when you said you started out right out of college, basically in the financial industry, can you be a little more specific? Was that like with a bank or investment broker, or what kind of financial industry part did you get into?
Yeah, sure. So my family actually has been in the insurance financial world really all the way back to my great grandfather. Started a firm here in Lansing, Michigan at the moment. He started a firm back in the 1930s. And so I actually work in an office with my grandfather, uncles, cousin as well. So there's a lot of us here. So yeah, I started working with them, was trying to kind of figure out, we all do a little bit different things, but trying to figure out, what I was kind of passionate about, what I thought I could bring the most value to. And, just having the benefit of being around a generation older than me, they had clients who were in their 50s, 60s, 70s. And I was, for the first couple of years, just kind of shadowing a lot of what they were doing, sitting in meetings, learning about people's situations. What did they like about what they were doing financially? What did they not like? But having that experience of being able to see, what was happening on the back end of the planning that they had been doing for decades was fairly eye-opening to me.
Cool. Yeah. So there is kind of like a Brogan clan that.
Yeah, there is. Yes, there's a lot of us for sure.
Has been added for 100 years almost, or something like that. Very cool. Now, and please take this a little bit, these next few questions, maybe with a little bit of a cheeky smile on it, but you said that while you were sitting in these meetings and listening when there were conversations with people who had been investing or had gotten closer or maybe even into retirement, that they were not as excited as one might expect or didn't see in the end the results that they were hoping. I wonder, were the taxes that they were expecting to pay really lower than what they were told when they put this tax-deferred money into accounts?
Yeah, you hit the nail on the head. It's exactly that. The people who were primarily banking on these qualified plans, 401ks, 403bs, IRAs, whatever name they go by, when they got towards those retirement years, or, and they'd accumulated large sums of money, 7 figures of capital in these accounts. But as they started to realize, okay, what's the cash flow, the actual distributions that I can get into my pocket after taxes? I mean, that was pretty eye-opening, because taxes were significantly more than maybe they were planning on. They didn't find themselves in a much lower tax bracket than than they may have been told that they were going to be when they got to those retirement years for various factors. So what I noticed is that really, it's not that the stock market is bad in and of itself. I mean, a lot of the people that we work with today still use it in some capacity. But what I found is the people who had cash flowing assets that would weather them through whatever, kind of market cycle they were in, if they had that consistent cash flow that they could predictably rely on from a month-to-month standpoint during the later years of their life, they were in a significantly better spot than people who were only relying on a certain nest egg or dollar amounts in these qualified plans. And so that, kind of leading to what you're going, that's what really led me down this road of, okay, what other strategies are out there? How can we help people maybe shift their mindset a little bit on this pure just accumulation, then distribution strategy? What other things are out there that could be a more effective way to create a dependable financial future?
Okay, well, that's very cool. And I think we're very aligned with that thought. I mean, even though I never really did a turn in the traditional financial industry, but for me, and the audience knows this, I retired from the military after 22 years, eligible for a pension, which if I had served like maybe 30 or closer to 40 years, it would be enough to potentially live off. But obviously with 20 years, even though I qualified the amount, even if you project it forward, when the starting amount is limited, then, incremental smaller changes don't really turn it into a huge amount. So it was always clear something else has to happen, right? And that's how I basically got into real estate investing and now helping other people do the same, because I realized, okay, this alone is not going to cut it. So where do I then put any kind of profits that we're making? Because I started a business, like good entrepreneur should.
Yeah, absolutely.
And start thinking, okay, so, if I want to find actually a way to not have to do this for the rest of my life, how do I do it? And passive income generating assets were the way to go. So we are very aligned with that. Now, the second cheeky question in that same direction is, what's the Brogan clan's prediction of taxes going to be for somebody who has, let's say, 10, 15 years ahead of them, 20 years until they get to retirement age?
Yeah, I mean, it's probably not too far off of what I can already see you smiling. I haven't even started answering the question yet. Yeah, I know, sir. So, I mean, I think the most fundamental question that we would ask someone is, do you think it's going to cost more money to run the government going forward or less money, right? And so as you ask people that question and you look at, just getting through COVID, which created all the stimulus, which, is leading to potentially towards a recession either soon or maybe down the road. And you look at where our government's going, it's only expanding their needs. We certainly believe taxes are going up. And I think as you ask most people that, if they really stop to think about it, they're going to realize, the government is getting bigger. There's more funds that are going to be necessary to do that. And the reality is I'm not going to be able to defer tax into an account and pay a substantially lower rate, 15 years later than I would be in today's world.
Exactly. And I appreciate you pointing that out. I mean, I asked the question slightly different, but I asked a similar question. And that is, have you ever seen the government, whether it's the US government or other governments in Western countries, ever substantially take on an approach to reduce the national debt? Seriously, not just a little once a year in 100 years, but seriously with that goal in mind. And obviously everybody says no. Well, and then the next question is, okay, so what happens to taxes when, let's just be modest and say we go with today? The federal funds rate is 3% to 3.25% today as of last week's increase. Well, on 30 trillion debt, which is what we have, that's $1 trillion just in interest.
Yeah.
$1 trillion just in interest, right? Now, we're still adding every day to those almost 31 trillion. And we just got last week notice that the Fed currently says by the end of 2022, early 2023, we are seeing ourselves between 4.2 and 4.5. So that is increasing. Interest is increasing. Now, is this going to be forever? Are we ever going to see interest rates down to maybe 2% or 3% again on the Fed funds rate? I think so, because we have to. but ultimately it's not going to disappear. And this notion, in my opinion, that people say, well, we inflate it away. Yes, you could make that argument that the value of those $30 trillion are going to go away. But as long as interest rates are 2, 3, 4%, that is a very, very substantial amount of money that has to be served. Even if everything else wouldn't be touched, every other service remains the same and so forth. And now, and I'm really want to ask you your opinion about that next thing, there is a guy named Elon Musk who says one of the biggest issues that people don't really address is the demographic development in the Western world. So how would you say, is he right? Is he wrong? Is it really something to be concerned about or not?
Yeah, I have heard him say that. I happen to be the oldest of 10 children. So my family they're certainly contributing to
Why he's
more numbers.
Too, right?
Yeah, exactly. So I haven't looked into that specifically. I mean, I would tend to agree with him, probably comes from a mentality of, are people going to continue to produce? So no, I would certainly think that that's something that needs to be taken into consideration. And hopefully, we can start trending towards that direction, because it looks like, if you look at trends, that it's going the opposite of what he's advocating for at the moment.
Right. Well, I mean, the thing about it is that I see, and there is obviously an opportunity in a way to change this at least a little bit, and that I'm going to get to. But fundamentally, if you go and say, okay, what are the actual numbers of the birth rate in the United States for the last 20 years? Up, let's say, until the end of 2021. We know this. These babies have been born. Right? I mean, that's just, so we have statistically those numbers. Now, the one thing I always say as a caveat is, I don't believe it anymore. I'm an immigrant myself, but I don't believe that. I've lived here literally for 27 years. And even before we came here, there was always talk in the US political discussion that immigration needs to be addressed. But in 27 years, it hasn't been addressed. And if you were to ask me, do you think it's going to be more or less likely that it's going to be addressed? I think it's less likely, as long as the division between the two major parties keeps getting deeper. And even if it were to stay where it is right now or where it was 4 years ago, I have a really, really hard time seeing them agreeing on that, when the one side is saying close the border, send everybody back, make all the illegals leave the country, and the other say, well, we have sanctuary. And I'm not even saying right or wrong, good or bad. I'm just saying the one thing that could basically change this birth rate pyramid is some solution to immigration, to say there is a high desire of a lot of people coming here, and that would add young people in the majority, especially for them getting the benefit of becoming a citizen if somebody is born here, to maybe dampen the blow that the Europeans and the Asians in very, very severe numbers can see already. On the one hand, it's kind of cool that Japanese life expectancy is above 85 now, right? So they must be doing something right about their food and the healthcare and stuff like that, and the way they live their life. But that only takes you for a little bit. Their birth rate is like so minute that they literally have started to reduce population now. And it's accelerating. I mean, the data is all available, like I said. So why I'm even bringing this up is, one of the slogans that we use at Idea Wealth Grower is a path to early retirement, right? And I want to pivot a little bit to the capital avalanche that Money Insights has on its website, and that I'm assuming, and make an assumption here, Blake, that you are very familiar with. So my opinion is, and obviously as somebody who advises other people to invest in value assets, real estate, and passive income opportunities, my opinion is this whole spiel that dozens and dozens and dozens of millions of people working and putting money into 401k plans is a huge deception. Because like you said, number one, the taxes are not going to go down. To just serve this 1 trillion plus a year in interest, we'd be lucky if they don't go up. And the stupid thing we want to tax the billionaires, as if these billionaires are idiot enough to stay around if we want to start taxing them, right? So anyways, so that means it's not going to go down. If we're lucky, it might stay where it is. If we're unlucky, it's going to go up. And there are less people to actually pay anything in, meaning like paying taxes, to serve for those who are Social Security, Medicare, Medicaid, and other recipients of what they put into the system. So with that being said, you said high income, and on your website, you say we're serving high income individuals. Kind of funny, I had to chuckle a little because all the examples of these high income people seem to be doctors. But I don't know if that's just coincidence.
Yeah. We do happen to work with a lot of doctors, physicians. That's certainly not everybody. That's kind of been, in a way, the people who have been pretty attracted to what we do, some of the services
But if you
that
had
we provide.
an entrepreneur to stay with your degree who's doing well, you would accept them, right?
Oh, absolutely. Absolutely. And so on top of that, we do work with a lot of business owners. That would kind of be the other category. It's kind of hard to, I guess, maybe just to have a picture of a business owner. They could look like anything, but certainly the people who kind of fall into our kind of niche market are high income earners, people who are looking to generate cash flow either in today's market, down the road, looking for alternative strategies that are beyond just parking money, as you said, Axel, in the 401ks, the IRAs. Where can we position dollars to create the largest amount of tax-free retirement income, places that aren't going to be, hit from the government? Strategies like that, strategies to help people enhance what they're doing kind of on the turnkey real estate side or other real estate investing. Those are other strategies that we teach as well.
Yeah, absolutely. And we are very aligned in that because that's what we recommend as well. And I went through the video with the Capital Avalanche and immediately said, yep, totally aligned with what Blake is saying. Now, people probably, while they're listening to us, not necessarily going to the website right now. So Tell us a little bit. And I think it would be nice if you could emphasize a little bit how the Capital Avalanche actually helps to make one's money work more than once, so to speak. Right?
Sure. Yeah. So the Capital Avalanche, really the idea of it, and if you want to learn more, you can go to moneyinsightsgroup.com is the place where we have a lot of educational videos there. But the idea of the Capital Avalanche, a lot of people are saying, okay, I'm making good money, but where do I put it? Where can I park these dollars to create maximum benefit for me down the road? So what the Capital Avalanche allows you to do is create a predictable double-digit return on your capital over the long term, which I know sounds aggressive, but with our strategies, we're able to do that. And then kind of one of the big benefits is we're taking capital that we're putting away and creating just a maximum tax-free retirement income stream from those dollars. You have liquidity over those dollars. So it's not something like a 401k where you're parking money in a place where you can't access it, at least without paying penalties and taxes until age 60. This is money that you might not have 100% liquidity of, but you would have access to be able to tap it if need. So it can provide you liquidity for your state, for your business. A lot of business owners love this strategy if they have business reserves that they need to have liquid, but also they want their money to be doing something a little more productive than sitting in a bank account earning, 0.25% at best taxable. This can be a good solution. So the way that it works is really we're taking very special types of insurance contracts. So they're insurance type of policies that aren't necessarily focused on the protection side, but more growing cash value. And so what we like about those is they're able to create a very steady, consistent rate of return. So it's not volatile like you would have in the market. So there's nothing really magical about these insurance policies other than that guaranteed consistent growth that we're able to generate. Plus, then what we do is use leverage outside of that. So for someone who's saying, okay, I can put some money away and I want that to be able to grow, if you're only using your own funds, setting it in an account, in a strategy like this, you may be able to generate, up to about a 5% return. So that 5% return, obviously, it's not going to blow anyone's socks off. It's conservative, safe. We know it's dependable. We know it's going to happen. But then when we're using outside leverage, as opposed to just putting our own money in, we're able to leverage outside money from banks they'll contribute to the plan in essence for us. And so because of that guaranteed growth that we're able to generate, plus the bank coming in and providing that leverage and providing more capital, more dollars working on our behalf, we're just able to create some very significant returns over long term by earning more in our policies than what we're paying on the loan side as well.
Okay. Yeah, that's very good. And thank you for kind of summarizing that. So one thing that I found oftentimes can help. Let's just, if you're okay with it, take my example and I'm basically going to present it real quick. And then you can tell me, did we do it right? Did we do it wrong? Where could we do it better? Right. So Number one, obviously, Idea Wealth Grower is a business, and I'm talking to a studied entrepreneur expert. So we're good. And the business has things that it's responsible for. right? Like, for example, the investment properties have mortgages that need to be served regardless whether the tenants pay rent or not, and so forth and so forth. So one thing that I always feel as an entrepreneur and business owner is I want to protect my family or anybody who's working within the company from, if I get run over by a bus, to be suddenly standing in front of a situation where it's not so clear where is money. So what I did, and following your example, is to say, okay, for the fact that I could be run over by a bus, I want to have a life insurance policy, but I want to have the kind where the money that goes in, regardless whether it's in one lump sum right at the beginning or every month, is not just providing, I don't know, $1 million or 2 or 3 or whatever the number is in term life, meaning like what they would pay if I'm no longer around, but where they actually use the money that is being put into together with hundreds of thousands or maybe millions of others, bundle it together and then invest it. And let me participate, as long as I'm still around, participate in the returns from those investments. So that's, I think it's called a whole life insurance policy that we created. And we're putting a certain amount every month. And we had an initial amount that we put in. Now then, we went with experts like you, Blake, to say, okay, well, so if this money is sitting there and it's absolutely secured, because if I get run over, then the policy pays, shouldn't I be able to borrow against it? And the bank said, yeah, sure. I mean, it's one of the most secure assets you can have because it's covered by an insurance policy, right? And we know that these insurers that offer whole life policies have been around forever, and they have to follow very specific rules, which I want to ask you about because I've never understood what those are really. And so they said, yeah, sure, we give you, I think they gave me 85% of what the actual value at the time in the policy was. So I got that into basically a checking account. I got basically my money that I just put in there and keep putting in there right back out. So while it was and still keeps accumulating for whatever good investments the insurance company makes, I have it back in my hand and I can use it the second time, for example, as a down payment for an investment property. And that investment property, or I wouldn't do it, and none of our members in Idea Wealth would ever do it if it wouldn't provide positive cash flow from day one. Now, if we keep doing this in the right way, the positive cash flow will ultimately be enough to serve the policy. But let's say the policy gets $1,500 or $2,000 a month. Well, if we buy real estate with it and it generates $2,000 passive income, it pays the policy by itself. And then we actually have it set up every 2 years to look at it again. And let's just say we were putting $50,000 in over the 2 years, plus the insurance company obviously did some good stuff with the money. Then we have maybe something like $60,000 that we can use 2 years later, again, as a down payment for 2 more houses, and keep going that way. So that's basically in a nutshell how I've done it and how I've helped and suggested it to our clients. Now, the one thing I've always been curious, and I hope you can help our audience understand, you said earlier the insurance companies have certain rules that they have to follow what to do with the money so that it's kept relatively secure. Can you talk a little bit about what those rules are and if that makes the returns bad, or how does that work?
Yeah, that's a good question. And to kind of follow up on your thoughts, those are strategies that we teach and we help our clients implement all the time, is really utilizing these specially designed life insurance policies built in the way that you're talking about as an opportunity fund, we refer to it as, for cash flowing investments. So we're right in line with that. So the companies that we tend to work with who are best for these type of strategies are what are known as mutual life insurance companies. So there's, in the life insurance world, there's stock companies and then mutual companies. We like to work with mutual companies because their primary focus is delivering benefit for policyholders. People who actually own these dividend paying whole life insurance policies are actually the ones who are getting benefits. As you said, those typically come in the form of a guaranteed interest plus dividends. You probably get dividends on your policy every year, which helps grow the cash value in them. So what they're doing is they're just accepting, huge amounts of premium dollars. They have billions of dollars that they're managing, and they can invest those because they're not beholden to a stock holder, right? They don't care whether their shares are going up or down on a quarterly basis. They're able to take a very long-term approach with that money. So if they have billions of dollars under management, they're investing in very conservative bond-like type of assets. They know, CDs, things like that they know over a certain period of time are going to generate a significant rate of return. but they're not out there going to hit home runs. So these are very conservative companies. One of the companies, well, really all of them have been around for well over 100 years. One of the companies I'm thinking of specifically has paid a dividend to their policyholders every year since 1859. So that's through world wars, Great Depression, you name it, recessions. Not only have the companies been profitable, but they've had profits to distribute to their policyholders every year for 170 years in a row, essentially at this point. So the way that they invest is very conservative. They're taking a long-term approach, and they're able to pass those along to, policyholders like you and I.
Yeah, absolutely. Now, one thing, and tell me if I see this correctly, you mentioned that some of them have paid dividends. I'm not sure if it's really called dividends, but dividends or something equal to a dividend for a very, very long time, which also means most people, if, obviously, ideally would start your life insurance policy, entering college, or maybe their parents should actually set one up. I actually am one of those weird people. I set one up when my daughter was 1.5.
Okay.
And it has a initial, what I put in is until she's 65. Now she can extend it beyond that. But when I first talked to her about it when she was like 18, 19, she's like, Dad, 65, that's so far away. What the hell are you talking about? Right. So yeah, but the point that I wanted to get back to is this long-term component in life insurance money. If you just look at it from a money perspective, I think if we really lean back for a moment and think about it, we should realize that even though their investments are what most people would call conservative, I would actually differ with you a little bit when it comes to they typically don't hit a home run. It's just not the instantaneous home run that you would see necessarily in a baseball game. But I would definitely say, if you look, for example, at the real estate investments that some of the larger insurance companies have made, because they have ventured in that market as well, anything that they did between, let's say, 2012 and 2018, early 2019 was basically a home run in the last 3 or 4 years.
Sure.
From an asset value increase. And we both probably agree that they have bought bonds, and they are buying bonds more probably than real estate right now. And I just looked it up yesterday. You can get MGM bonds, which is a very reputable casino operator for the last 100 years or something like that, for above 6%. And if you go a little bit more risk, you can go even into 8 or 9%. I don't know if insurance companies are allowed that, but there's typically a spread, right? So if the Fed is at 3.5, corporate bonds are like in the 6, 7, 8. If the Fed keeps going towards the end of the year in the 4s, you might see 8, 9% bonds, right? And obviously right now the shorter bonds pay more than the longer ones, but the insurance companies have whole departments, from what I understand, that do nothing else than basically run the money of their policyholders like an investment banking operation, even though they're officially an insurance company. So I think this is, another tribute to, if you have a long-term perspective, and these companies, I think their long-term perspective is the lifetime of the insurance company, not necessarily the length of the policy that any individual holder has, right? So I think that should give us pause, that how safe is the money to put it there, right? How likely is it to get a return out of it? And how cool is it that you can then right away turn around, get it back, and do some cool stuff with it that is generating passive income? Now, we talked about just briefly about the developments. Where do you see these current developments about the economy, inflation, Fed rate increases and stuff? Where do you and your organization see that going?
Yeah, I mean, certainly, I think we probably, knowing a little bit about your company and the type of people who are in your audience would probably be very aligned that, you look at where our country is and where inflation is. I don't really see it getting trampled down too much here. It seems to be kind of off and running. So especially if you're someone who's sitting there thinking, okay, so what am I doing? How can I get my money to work harder for me? Or how can I position it in the right place to take advantage of cash flow, appreciation, depreciation? I think some of the strategies that you're teaching with turnkey real estate investments, I mean, we have many clients who are turnkey investors. In fact, we just had a lady who was looking at getting a turnkey short-term rental up and going, and she used some of the same strategies that you were just talking about, where what she would do, or what she did, was, as opposed to, she was about to put $100,000 down onto this short-term rental, And so as opposed to just taking dollars that she had in a checking account and then using that for the down payment, get financing for the rest and create the cash flow off that property, she did the strategy of overfunding a whole life insurance policy. And then why would she do that? Well, because now the dollars are in the policy, so they're going to grow by a significantly larger rate than she was getting in her bank account, upwards of 5%. She could do that on a tax-free basis. She also had that protection that if something were to happen to her, if she were to pass away unexpectedly, her family would have a large windfall. So things like that. So she's got the money in the policy, but she wants to use it for investing. Well, as soon as she funds the policy, she can turn around right away and take a loan against that, which it sounds like you've done. You encourage your clients or your people in your community to do as well. So when she takes that loan against it, and again, she does this a couple of weeks later after funding the policy, she turned right around and took a loan against that policy. Well, when she receives that money, that's actually money coming from the insurance company. So she didn't have to withdraw the funds from her policy. So what does that mean? Well, that means all of her money, that $100,000 is still in the policy. It's growing. It's earning uninterrupted compounding interest. It's growing tax-free, all those benefits I mentioned. And now she leveraged that, took the $100,000 of the loan that she was able to take, go buy the same short-term turnkey rental property that she was planning on purchasing originally and just use the cash flow to repay the loan. So the end result of why she wanted to do that was, as opposed to just having her money working for her in the short-term rental, now she had it working for her in the policy, earning a rate of return there. And she had the money working in the turnkey rental, short-term rental business as well. So just by layering in that kind of strategy, she now has her money working for her in two places at the same time.
Yeah, absolutely. And I think this is also interesting because we're always discussing flexibility. Like, how can you, if you have created this kind of a structure, gain some flexibility when it comes to decision making, right? And so in this case, using your example, this client, she can basically say, okay, the positive cash flow that comes out of the investment, which I'm assuming you would advise them to do, either I can put it into the insurance company as payment for the premium. I can also use it as extra principal payment to the mortgage that I have in the investment, which means the mortgage gets paid off faster than the original 30 years or whatever the mortgage was for, which means ultimately I get to the full cash flow rather than the depressed cash flow sooner, and can then put that into the insurance policy if I want to, or buy something else, but have a property free and clear sooner than going all the way through 360 months or whatever the term of the loan may be. So that flexibility to decide, I can say I buy something else with it, right? So I have 3 or 4 different things I can do when I have these vehicles in place. Now, there's one thing when it comes to inflation that people say, well, the buying power of our dollars is losing right now at 8.3% or stuff like that. How do you basically explain what that actually means to your customers?
Well, the value of the dollar is going down every day. The question that I often get asked is, okay, what options are out there for me to do something about that? And a lot of times it's looking at that long-term fixed rate debt that can actually be a benefit. So for, and I'm sure a lot of your, this isn't breaking news to a lot of your listeners, but if you think about, okay, if I can lock in a 30-year fixed mortgage, right? What's also happening with inflation is the cost of servicing that loan is going down each and every year as well. So it goes back to what you were saying, Axel, about having options, right? So as she's starting to create cash flow from this, yes, she's not restricted to doing one separate, one specific thing with the money. If she wants to service the debt with it, that she took the lien to go get the short-term rental, she can do that. She can use it to fund back into her policy. A lot of it has to do with what she has access or what she wants to have access to. So yeah, we just, inflation's real. Again, that's why a lot of the strategies that we teach resonate with people, because of the fact that they want to have some safety. They want to have liquidity over their money. They don't want to put it in a 401k and just lose access to it, but they want to have that money doing something for them, right?
Yeah, absolutely. Yeah, I totally agree. And we basically say the same thing. One thing that, maybe you want to use that as an alternative explanation to that question that I've been using lately is, and I've gotten a little bit of flack because I cited Michael Saylor, who is currently not in favor of people because of his Bitcoin investments. But what he said really resonated with me, has nothing to do with Bitcoin. He said, I live in a house that I bought when I got basically into some money because of being an entrepreneur and starting our company and being paid well, somewhere in the Miami area in Florida, right by the water. And he said this house, and he didn't buy it himself, and was in the family, kind of like in your family, probably you might have some assets that have been in the family for a long time. And he said when that house was first built, the building cost for this house was $33,000 in 1910 or 12 or something like that.
Yeah.
When he bought it, it was $300,000. Right now, it's probably somewhere in the $3 to $5 million. And what I thought was a striking argument that I have been using lately is when you think about what is a house for, it is to provide a space for a family to live and grow and enjoy and have barbecues and Thanksgivings and stuff like that. But from the service, the thing that it actually does is it provides shelter to the owner, right? Maslow's pyramid and stuff like that. And so why is it then that it increases both in value over the time and in rent, if you were to rent it over the time, is not because that value of providing shelter is somehow less. The value of the shelter in 1960 and 2010 and now is pretty much the same. But the value of the money has collapsed massively, 99%. So if you want that same value at the beach in Miami, in that same house, you have to probably pay $5,000. If you were renting it in 1910 when it was built, it was maybe $150. But those $150 were worth so much more that they were equal to the value that the house provided. And now you have to put in $5,000 because these individual single dollars have basically very little value. And that's what inflation does, right? Like they basically reduce the value right now with 8% per year. So you have to give more and more of these less and less valuable pieces of paper to get the same service, like rent or the shelter in a house or anything that has any kind of equal value over time. So I think that is helpful, even though it comes from Michael Saylor, as kind of like putting it in perspective. What do we really mean when we say the buying power of our dollars goes down with inflation? It's you need more of them to get the same thing, basically, right? But from an investor perspective, it's obviously awesome because we pay one price and we have a fixed mortgage. And we can reasonably expect that rent will have to increase if for no other reason that the value of these dollars that the tenants are giving us is less and less valuable. So do you resonate with that?
Oh, absolutely. And I think even using a piece of property in Miami is probably the best explanation for that because the prices did just exactly what you said in your example. And the reason that resonates with me is you think about, again, some of the more traditional wealth building strategies are the opposite, right? Where we're contributing our most value. If dollars are more valuable today than they are going to be in the future, and we're contributing today's dollars into accounts that we can't take out for 10 years, 20 years, up to 40 years, depending on how old you are, right? The value of those dollars are going down. Where if we look in the alternative space and real estate, using your example, you're paying a price today, you're putting capital in as an investment, and then just naturally the value of that investment is going up because of how inflation works. So you think about the two separate kind of ways of thinking about how to grow dollars for the future, and they're just the opposite.
Yeah, absolutely. And I mean, I want to also address and get your opinion about it. Is a lot of people say, well, but when I look at the stock market, and if I were to invest in the stock market, which is basically where a lot of 401k investments go in mutual funds and index funds and stuff like that, then I have on average 6, 7, 8%. And what I have been saying is I don't even want to argue about the stock market. I want to basically make people aware that there is an enormous amount of truth in the statement, nothing is forever. And what I mean by that in the context of investing in the stock market is there are things that are maybe not forever, but building a house is probably something that you can reasonably expect to be around for 100 plus years. Now let's look at your phone. Your smartphone has the capability of making awesome pictures because it has a digital camera. And they keep charging you more and more because supposedly the pictures get better. But when you go back and say, who came up with this? The amazing story is the people who came up with this first were the people that were running a company named Kodak. But they were so stupid not to believe that digital cameras would be the thing of the future. So they insisted that the old cameras where you needed to put a film in it, or you bought the little cardboard box for the wedding, that is and will always be how pictures are taken. Others saw that they had come up with a digital camera, but didn't believe in it. And so they ran with it. And Kodak is, I don't even know if they're still there. And you can go into many, many other companies like that, right? Like, for example, HP, right? Were the absolute leaders in inkjet printing. Well, that only really makes sense as long as you all and everybody in the whole world is using paper that you want to print on. Now, that doesn't mean we don't print anything anymore, but the amount of stuff that needs to be printed is massively less than it used to be. And I can say, at least for my daughter, when I look at her office, she runs her own business. I look at her office, it barely has any paper. And when I say, how do you do this? She says, I do everything digital. It triple protected with different storage and backups and what have you, but no paper. Well, if you look at what HP was and what they are now, the little pieces that are left of it, it's the same kind of story. Not quite as bad as Kodak. And you can go down the list and say, okay, what were things that we used to do, people used to do in our lifetime, in my lifetime at least. And, like I remember we watched Star Trek when Spock went to a new world and he had that little thing on his arm that he typed on to say, okay, what's the temperature and what's the humidity and stuff like that. Well, we're not quite strapping it to our arms yet, but our phones are completely capable of the tricorder things that they did in Star Trek, right? Yeah. And probably more. Like I have never heard Spock play music on the tricorder or anything like that, or take pictures with it.
Take pictures, sure.
Watch videos, you name it. So that's just in one lifetime between what somebody thought would be possible and what we are actually living every day. So why am I bringing this up? I want people to really think about what are the things that have a reasonable expectation to be around. You mentioned, like more than 100 years in the life insurance industry. I mentioned more than 100 years reasonable expectation with real estate and the physicality of the building, while other things come and go, right? And even in a cycle of 25 to 30 years, what used to be normal, like, Netflix sent out little DVDs in envelopes. It's unimaginable if you look at the streaming industry today, right? And on and on and on. So I think it's important to really take a look at that. Now, with all that being in mind, when we're talking about high income earners, like you say on your website, Blake, can you give our audience, maybe to finish up our content for today, a little bit of who would be the right kind of, or the typical kind of clients, other than maybe doctors that we mentioned already, that would really benefit from working with you?
Yeah, so it's probably in line with a lot of what your people are already doing, but it's those who are looking for alternative ways of building wealth. And so what we do is, because we don't want people just to take our word for it, we have videos and other information really available on our website. Again, that's moneyinsightsgroup.com. So feel free to go check that out and see if some of the things resonate with you. But yeah, for those who are actively investing into turnkey real estate, I would look at the investment optimizer. It's the strategy that we've talked about. And really all we're doing is taking what you're good at in the investment world and just adding an additional layer of profitability to what you're already doing. So if you're someone who's building up money in a bank account, liquidating that to go invest, and as that cash flow is kicked off of that investment, it goes back into the bank accounts building up. You may love what you're doing on the investment side, but you may say, hey, is there more I could be doing with my money in between deals? Is there a way for me to add a layer of efficiency? And that's really what we specialize in. Or if you're someone who's saying, hey, I have money that I want to set aside for the future, I want it to, be able to create significant rates of return over the long time. I like the idea that I can put my money in a place and I can take it out tax-free. I could have liquidity. Then again, the Capital Avalanche, which we talked about, we have more resources there as well, but that would be something that you would take a look at. So really, at the end of the day, it's anyone who's interested in building wealth, wants to know what type of ideas there are out there, maybe outside the mainstream. Feel free to take a look and let us know if it's something that's of interest to you.
Okay, yeah, very good. And thanks for the summary. One quick thing as a follow-up. Do people need to be accredited, or do you basically allow others to be investors with you as well?
Yeah, with our strategies, you do not need to be accredited. So that's not a a prerequisite. A lot of the people that we work with tend to be accredited just because they're investing in things that do require, to be accredited to invest. That being said, nope, all of these are available and they can be done on any scale, regardless of whether you're accredited or not.
So if somebody makes $199,000 a year, it's still okay.
Yes, they can still call. Yeah, we'll be happy to connect and see if we can help you out.
Yeah. All right, cool. No, that's very good. And I always recommend it. I mean, obviously we like to help our clients or anybody who's interested in our approach, but we're happy to share in the mindset of abundance. There's plenty out there for all of us. Now, to come to my last question, totally unrelated to investing, at least normally, and that is, and we mentioned Spock and Star Trek already, so a little bit. If you had the option to have a time machine, you know what you can go forward or backwards. You're not allowed to change the time-space continuum, but you can go and look either direction. Where would you go and why?
I think I would go back. I would go back just to experience the things that I've read about in history books. So specifically, I'm a big golfer. I enjoy golf and the history of golf. And so I think I would travel back to the origins of golf back in the mid 1500s, back to Scotland.
So you would go to Scotland and see them play golf without having a golf course, basically?
Yeah, it's when the first ones were being built, and just to see where we've come in that way, the ways our bodies have changed, the way that the whole sport has changed. That would be super fascinating for me to see where it all started and how it's made it through, nearly 500 years
cool.
now.
Yeah, maybe if you can find an app that gives you the chance to do an avatar that looks like a Scottish 1500s or 1600s golfer or something like that.
They looked a little different than Tiger Woods and all of the guys on tour look like now, I'm sure.
Well, I don't know what it is, but they all had this kind of weird hat on. All the pictures I've ever seen, as if that's
weird hat. They were wearing like suits, like with ties around their neck.
Fluffy pants and stuff.
Yeah, it's like, how did you think that was going to be the best outfit for your performance today? But
yeah, I think they looked more at standing in society than as we do right now, associating an outfit with a particular activity. Right? If you were higher enough up in the food chain that you could even consider playing golf and not kind of digging around in the fields, then you probably had a certain standing that came with a certain expectation of outfit or stuff like that. That would be my assumption.
I think you're right there.
Although, I mean, they switched outfits between golf and hunting, so not much. They still had the same kind of weird pants.
Yeah, the pants were a problem.
Right. Well, I mean, you never know. You might want to try them. They have maybe some things that we don't know that makes them good, So, all right, cool. Well, Blake, thank you so much. You mentioned it a few times, but one last time, how can people get in touch?
Yep, moneyinsightsgroup.com. A lot of free resources there for you to browse. And then there's opportunities on the website to reach out if you have any questions.
Okay, awesome. Well, thank you for making the time, telling us a little bit how the Capital Avalanche works and how you serve clients, even if they're not accredited. And I think we're very aligned. So thank you. And let's stay in touch.
Yes, it's been fun, Axel. Have a good one.
All right, cool. Thanks. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.